With fears of the COVID-19 virus continuing to wreak havoc on global stock markets, the last thing traders were expecting was a price war in the oil market. But that is exactly what happened when the recent OPEC meeting fell apart amid disagreements between Saudi Arabia and Russia. The result? The steepest drop in oil prices since the first Gulf War in 1991.
It couldn't come at worse than any other time because of the serious concern over the economy, global economy, as a result of the coronavirus. This is still spreading and still going on in China and outside China, while in the same time the suppliers simply couldn't make any reach any agreement on the supply side.
In a bid to cope with declining demand for oil amid trade and airline disruptions due to the coronavirus outbreak, OPEC's de facto leader, Saudi Arabia, proposed cutting production. Russia, which is not an OPEC member, refused to go along. In retaliation, Saudi Arabia announced plans to raise its production capacity to 13 million barrels per day, up from 12 million at present. This sent prices tumbling to around $36 a barrel on Wednesday.
It does seem to appear that economics is taking a step back at this point of time, and there appears to be some hints of political motivation in their decisions. And on top of that, bearing in mind that Saudi Arabia can produce a barrel of oil for as low as $8 to $10 a barrel, I think they can take prices at this level for now. And given the stakes involved politically and economically, it does appear to me that I won't expect Russia or Saudi Arabia to be coming back to the negotiation table anytime soon. Not in the next, I would say, 3 to 6 months at least.
Experts say the world was already facing an oversupply of oil due to the US-China trade war in 2019. With this new price war, it would appear that we will see low oil prices for some time to come.
OPEC producers have very little incentive to cut down on their production. March 31st is the deadline for the agreement. After that, I doubt that the agreement would be extended. So with Saudi Arabia attempting to take back market share with more production going forward in this tension with Russia, I don't think other producers would want to comply to any cuts. So going forward, the oil market is going to see a sharp oversupply.
Of course, lower oil prices may not necessarily be a bad thing in this current economic environment.
Asia is known for the biggest sort of importing region for both oil, LNG, and coal, all the three main fossil energy. So the import bills will be lower, and the government, state-owned companies in particular, they may benefit because overall the lower cost of the crude intake is a good thing for them. Shipping industry will also see the lower fuels, and airlines for sure benefit from direct cost reduction of jet fuel. The lower price means demand can be stimulated, right? When you have such cheap prices, gasoline, diesel, the consumption and industrial activities will be stimulated.
However, countries that produce oil at a higher cost are set to incur steep losses and may even be pushed out of the market.
US shale producers are probably the ones to lose out the most this time around. Their cost of production is higher globally than Saudi Arabia or Russia. And right now they are highly indebted. US shale producers are highly indebted. They have very limited borrowing power right now, as most banks are not willing to provide them with funding. So at a time like this, with economic impact of COVID likely to be quite severe, this is a very bad timing for oil prices to go down.
One beneficiary of the turmoil in oil markets, however, has been gold. investors have been seeking refuge in the traditional safe haven asset as both oil and stock markets seem too risky for now.
My only surprise is that gold hasn't broken its record high of 1,917 yet. I think it's largely because people still expect gold to be relatively suppressed as the COVID-19 is transient in nature compared to the record high of 2011 when gold had to rally due to structural changes in the financial system. And I think that suggests to me that there will be some difficulty for gold prices to continue rallying. And I think it might see a cap at its record high of 1,900 at this point of time. But if the COVID-19 situation becomes worse than expected, then I think it might make a run for $2,000 per ounce.
Experts say that investors should pay close attention to economic data coming out in the next few weeks, and in particular any movements made by the Fed, which could either support or derail the gold rally.
Right now, it seems that the virus has kind of peaked in China. Numbers of new COVID patients has started tapering. Factory workers have started to go back to work. So right now, things look like most of the lockdown could be lifted by April in China. But if it doesn't happen, you see the virus mutating, more people are getting affected, and the Chinese economic impact looks to be more severe by April, then this could lead to more uncertainty, and that will lead to higher gold prices.